2021 has been a great year for selling a home. Prices have increased dramatically, and with that, so have questions about whether the gain on selling a principal residence is taxable. Many taxpayers remember the old rule, which, by the way, was repealed in 1997, where you had to reinvest your sales proceeds within 2 years to be able to exclude the gain. That makes this a good time to review the current rule for excluding the gain from selling your home. The general rule is that you can exclude up to $250,000 of the gain, $500,000 for joint returns, if you meet certain qualifications. First, you have to have owned the home and used it as your principal residence for at least 2 of the last 5 years. You also can't take the full exclusion if you use the exclusion for another home within the past 2 years. So you can see, despite the rapid rise in prices, it's still unlikely that most taxpayers will have a gain that exceeds these limits. There are even exceptions to the 2-year rule for work-related and health-related moves and certain unforeseen circumstances. There are also special rules for surviving spouses, divorces, and in the case of a transfer from one spouse to the other. To measure the gain, subtract the cost basis of your home from the net sales proceeds. The cost basis includes what you paid for the home, including most closing costs, plus any improvements you've made along the way. The net sales proceeds from the sale is normally the sales price less selling expenses. If you're close to the exclusion limit, good record keeping is a must. If you find yourself close to the exclusion limits, or if you want to see if you qualify for an exception, contact your DWD accountant to see how the rules apply to your transaction.